Peter Rose, Longwood Currency Trading. How do you do chart time frame comparative analysis? And what the hell does that mean anyway? You have different time frames that are on your charts, right? You got a 4-hour, you got a 5-minute, you got a 15-minute. Those are time frames. And so how do you use those time frames? Because a movement on a 1-minute chart may or may not be as significant as a corresponding relative distance movement on a 4-hour time frame, for example. So if you look at a 1-minute chart and it moves 10 pips with an ATR of 2, how does that relate to a time frame where the ATR is 30 and it moves 50? Is there a relationship that's scored, and which counts for more weighting in your analysis than another? You have to have a base to go on, and then you can relate everything else to that base. And what I'm going to do is I'm going to take you take you over here to this. Now, those of you that have been with me in a few videos know that this guy here is the snow depth chair, okay? And this level up here is about 34 inches, something like that. And we've got our snow all the way up into here. There was a picture of that I think I put in last winter where we had the snow up to there. And it's like 6 inches to there and 18 to there, whatever it is. Why am I talking about the snow depth chair? Well, because you need a base. You know what the base for the snow depth chair is? It's the ground. It's down there. I'm not going to bend over and point at it, but obviously that's what the situation is. You have to have a base to determine how deep the snow is. Where are you relating the depth of that snow? What are you relating it to? Are you relating it to 10 feet in the air, or where? No, you relate it to the ground. Well, I'm walking down here toward the chicken coop. We don't have any chickens and never will, but it's the chicken coop. So I'm walking down here, and you look back up toward where the snow depth chair is, and you can see that there's this arcing hill that goes up to the snow depth chair. So that means that the level that the chair is sitting on is higher than the level I'm at here. What does that mean? Well, it means that if I'm standing here and the snow measures 6 or 7 inches up onto my leg, if I go to the snow depth chair, even though the relative height of the ground is more and the snow measures 6 or 7 inches, it's the same 6 or 7 inches of snow. You'd say, we've got 7 inches of snow. I've got 7 inches of snow down here where my foot is. And I got 7 inches of snow up against the snow depth chair. So from a relative standpoint, we can say that we've got 7 inches of snow, regardless of where I am, because the base is the same point that we're measuring that distance from, right? What does all that mean? What difference does this make? What does it got to do with charts? Each chart is its own base, right? I mean, if you're on a 5-minute chart with a 5-period ATR, then everything is relative to the base of the ATR. Well, yeah, but that's not the real base. The real base of the currency price is the order flow, which is generated by mostly the institutional traders in this almost $7 trillion a day market. 85% of that order flow is institutional. We're a small 15% of that order flow. But it's a huge order flow. Are we creating the base of that order flow? No, we're not doing order flow. We're trading. It's the institutions that are running the order flow, and that's what controls the bias direction of the currency pair. Do you think that even as big as the retail market is, that we're going to be functional in determining what the ultimate price of a currency pair is? We have nothing to do with that. We're simply providing liquidity. Now, that's not a bad thing, because you can make money by being a part of the liquidity, because all we're doing is getting on the train and riding it a little bit. You know, somebody who's traveling is trying to get from Chicago to St. Louis, let's say. But we only want to ride the train to Joliet. So what do we care if it's going to St. Louis? We just know that the direction is headed toward St. Louis, and we're going to get on that train, and Joliet's where we want to stop, because we're not really sure that the train won't veer off after Joliet and go to Kansas before it comes back and then continues on to St. Louis. So we don't know that. We're not really sure. Well, in a train we are, but in currency trading, you know very well that's not the case. Who's controlling the order flow? It's the institutions. So the question then becomes, what information, what base information are the institutions using in order to judge what they should be doing with their client orders? What are their clients telling them? I want to buy dollars, but I don't want to pay more than this. And so the institution then buys dollars until it gets up to here, and then sells dollars to bring the price down, and then buys them back. That's where you find the ranges. Great. Well, what are the institutions using for their range chart? The weekly? The 5-minute? Both are ludicrous. They're using, for the most part, probably the 4-hour chart. Because on a 4-hour chart, you're picking up a long string of days. The institutional trader has a maybe $2 to $5 billion order, big manufacturing order. They're not going to dump that out in 15 minutes. They're not going to dump it out in maybe 15 days. They're going to have to trickle that into the market for liquidity to match other people's needs. Some people may be feeling that they need to buy dollars, right? And others are selling dollars. It's a zero-sum game. Somebody's going to win and somebody's going to lose. But even the people that lose may be winning because they may be getting out of a position that's been in profit. The loss is the person is betting that, on the buy side, is betting that price is going to continue beyond that. And so the thought is, well, you've lost this gain by getting out. But they've already made their gain. So even though it's a zero-sum game, ultimately, one person's not going to benefit from that move, either because they're wrong or because they got in and bought at the right time, so they catch that increased value in the pair, or whatever is distributed there. It all has to do with economics, and I'm not teaching economics. You know, you need to know and understand order flow. Why would the institutional trader go on that 4-hour chart? Because you get a good detailed view of what's going on. In other words, 4 1-hour bars are encapsulated in one 4-hour bar, so you're really getting the 1 hour heartbeat of the market. But you're also at the 4-hour chart getting all the way back into what a weekly chart would show. You're not getting that many weeks. I mean, what are you going to be looking at in your chart? As you splatter the thing up against the screen, you may be getting 200 bars of whatever you're doing. I mean, 200 bars of 5 minutes, 200 bars of a week chart, whatever. You're looking back 200, 300 bars. I don't know how big your screen is or how far back your particular trading platform is going to have your prices. You can always use the scroll bar to go back, but in one screen full that you're looking at on that 4-hour chart, you're getting the long-term view, but you're also getting just enough detail of what's going on right now in order to try to figure out how you're going to get your client the best price. And that's what order flow is all about, getting your client the best price. That's what the institutional trader is trying to get. Now, sure, there are institutions that warehouse currencies. There's traders that just sit there and buy. That's all they do. They buy and they buy and they buy and they buy. Because someday somebody's going to want to buy a lot and they can sell and make their money. Well, by buying one currency, you're selling the other one, right? And so that's why there isn't, the warehousing isn't directly marketably affecting any one individual currency pair, because you can buy a shithouse full of dollars by selling 10 different currencies against the dollar. So that part of the market is like the ante that you put into a poker game. You don't even consider that. That's just the cost of doing business, and that stuff hums around in the background. In mathematics, what we could say is that we can factor out that as noise. It's going to be there regardless of what the situation is. That particular type of activity is always going to be there, and so you can negate it as affecting your particular campaign today or over the next 2 months, because that's just there. If you're going to go sailing, you're going to be sailing in the water and it has some waves. Some days those waves will be 2 feet, some days the waves will be 2 inches, but there is always going to be water with some waves. And so when you go sailing, you don't look at the water and go, oh, well, it's half-inch waves today, it's a quarter-inch, and you're always going to get some waves. You don't even factor that in. What you're looking at is the cloud formations and the buildings that are surrounding wherever it is that you are to kind of calculate what the wind is going to be, how much wind is going to go, because the longer the fetch, the longer the distance over the water that the wind blows, the more likely you are to get big waves, okay? And so we're doing the same thing in currency trading. We want to look back far enough to see if there's any big waves building up. But if you look too far back, what you're doing is you're averaging out. And what happens when you average? You smooth it out. So is the currency institution, the trader at the institution, concerned about what happened last year? He didn't give a shit about what happened last year. The only reason they'd be concerned about what happened last year is the 4 to 700 pip range, or maybe a little bit higher, 1,000 pip range that price has gone in over the last 5 years. So they kind of get an upper feeling for what the market is willing to buy their currency at, and a lower boundary to where they're looking to get to sell. And so somewhere in there is the playground, the availability of currencies and their movements. So if you're way, way, way here at the top of the 5-year range, are you going to be aggressively buying currency? No, you're not. You're going to be very cautious. If you're down here about a little over half of the way up to that higher range, I mean, that's could be 1,000 pips, could be 800 pips. It depends on the currency pair, right? So as a currency institution, that 4-hour chart comes in really handy, as does the daily. They're looking at the daily and they're going to look at the weekly, but they're going to be getting what they're going to do today off of that 4-hour chart. Because remember, when you're trading, if you're knocking out, let's let's say the orders that you want to fulfill today is $400 or $500 million. You're going to want to splatter that over the course of the day, or maybe a couple of days. You're going to want to have that fine-grained view, right, of what the market is doing, not only from the institutional standpoint, but also the retail traders that are out there. Because a lot of retail traders get it wrong, and somebody who's astute can look at that and go, wow, I can take advantage of that. And that's what they do. Anytime you see a pin bar, that's an institution. If you're looking at a pin bar on a 1-minute chart and thinking it's a pin bar, you're deluding yourself. Go out to the 15-minute and see what it looks like a little nipple, a pin bar. Pin bars are only valid up in probably about on the 4-hour chart. You start to see them on the 1 hour, but you could be premature on that. You get a pin bar on the 4-hour, somebody's doing something, and that somebody is an institution. Now remember, if you're trading $400 million for the day, what's the value of 1 pip? You know, if you had a $1 million account, the pip would be worth $1,000. $300 million? You don't really want that price to move that much against you. And you don't need it to move that much in your favor in order to accomplish what your client's needs are. And so we as retail traders have to balance the fact that there's $6 trillion a day sloshing around in this market, and holy shit, look at all the opportunity, with the view of the institutional trader who's saying, I really don't need to clip very many pips because of the size of the order I have. So I can go in there and grab a few and wait, go back in and grab a few and wait, go back in and grab a few and wait. And that's where you get these trends. And the quick reversal of that trend in a pin bar or a swing, which may be not a major swing, but just a we'll call them a retracement swing, or a pin bar that indicates change in direction for a certain period of time, which more often than not becomes a swing point. But you know, you have to evaluate there's swing points on 1-minute charts. You know, you don't have to have a 4-hour chart or a weekly chart to have a swing point. There are retracements. It's just the magnitude of the retracement that you're concerned with. If you're a retail trader, a retracement of 50 pips, that's a huge deal, right? If you're an institution, a 50 pip move, you're not in that. You're just waiting until things calm down, and then you know they got to turn around and come back, and you can continue to fill your orders. It's not that big of a deal in the big picture of things until the institution is ready to unload everything that they have, and they don't give a shit. They're going to dump it in the market, and everybody's going to go batshit, and that's where you get the pin bar. So managing your charts, time frame analysis, managing your chart time frame analysis is really critical for you to understand what you're trying to accomplish. Are you trying to get 50 pips? Well, you know, you better really be paying attention to what's going on in that 4-hour chart and the daily chart or whatever, because 50 pips is a lot of pips to get. Me, I'm trying to lock 5 pips a day. That's my base. It's actually 8, but if I lock 5, even if you lock 3 pips 1,000, 0.3%, you can make a really good living at that if your account is big enough. But I'm looking to get about 8 pips of the 20 that I've identified as potential for that move, and I don't just have that 20 pip move because that's a short-term view. That's on a 5-minute or a 15-minute chart time frame that I'm identifying that. I'm really looking out at the 4-hour chart to say, what's possible today? Where is order flow at today? And not just today, but at 10 o'clock as opposed to 7:30 in the morning. What's happened between 7:30 and 10 o'clock? If you have a pair that's opening, like a pound, The pound in London for a U.S. trader opens at 2:30 in the morning. That's London open. U.S. time, it's 7 or 7:30 when those activities begin. So where are you judging the period that you're going to be at the trading desk? For me, I'm trying to get all my trading done in 2 hours. I don't want to sit there at the trading desk all day. I'm not going to work up these elaborate trading schemes that are, the price is going to go in, and then it could go against you a little bit, and then it's gradually going to go up, and at some point in the next 2 hours or 4 hours, the price will get to your profit target. No, I want to be able to look at that chart, make my decision as to whether there is a trading opportunity right then or not. But it's based on, is it ready now or is it not ready now? And that determination you get off the daily and the 4 hour, and maybe a little bit on the 15-minute. Or you use your 15-minute to plot your strategy out, and you use the 5-minute to execute, and you maybe use the 1 minute or even the 5-second to manage your risk for exit methodology. Remember, you have 3 phases that you're going to take this position through. You have your entry analysis, position management, and exit methodology. And if you don't understand those 3, and those, I haven't heard anybody break the position down into those 3 categories. I'm a software engineer. I was a software engineer for 33 years doing complex internet-based business applications, and that's how we broke our programming projects down into solving what they call the life cycle of the software development. The software development life cycle starts with some type of analysis, some type of, and then you move from step to step to step. And you can have maybe 6 or 8 steps in a software development life cycle. And I've simplified that into the 3 steps of the life cycle of a currency position: entry analysis, position management, and exit methodology. If you don't like that, and there are people out there who say, oh, you're full of shit and stuff. Look, I spent 33 years doing that. I'm pretty much an expert at creating business applications, and business applications mimic how you survive in the world financially. And so I think I've got a clue as to how to think about breaking problems up, complex problems up. The currency market is a very complex problem. It is probably one of the most complex problems outside of maybe gene analysis or whatever, because there's so many different permutations over so many different countries, over so many different currency pairs. It's really complicated. So you have to look at a process that will simplify that. And that software development methodology, breaking the problem up into manageable pieces, is directly mappable into the problems that we have to solve, which is how do you make money in the currency market. And so you have your entry that you have to worry about, which is the primary of the 3, because if you get the entry wrong, you're screwed, right? So entry analysis then maps directly into position management. What are you going to do once you've entered the position and you haven't stopped it out? What are you going to do with it then? Are you just going to wait for it to hit your profit target? Are you going to stage in? Are you going to stage out? Are you going to go beyond your profit? Are there all those questions that are dealt with in the position management phase? And then obviously exit methodology is how do you get out of the thing with as much money as you can. So you look at that position management. I just rattled off 6 things or 6 questions that might be necessary for you to take a look at. Well, each one of those questions is then broken down into a series of steps that logically takes you through identifying what's the problem, and here are the steps that you would need to go through. That's what I teach. That's the way I teach currency trading. And there's not many people that want to do it that way, because of what they want is the secret sauce. Tell me how to get in and where to get out. Well, I'm not going to do that, because there is no answer to that question. It actually takes work. If you wanted to learn how to drive a car, would you trust me if I said, get in the car and turn it on and drive? And yet that's what all that you see out there in your education. Oh, you just use the Bollinger Band, and then when it's blah, 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 and then you get out when this happens. It doesn't work that way. It's a problem that you need to solve, and you need to know how to solve problems. It's really simple. It's not easy, but it's really simple. And part of the solution of that is to understand how you manipulate or use the different chart time frames at our disposal as retail traders in mapping the solution of your particular situation at that particular time into a profitable trade based on the size of the bank that you have and your target goal being reasonable for a minimum goal for the day. And if it goes beyond your profit target, a reasonable process of extracting the most amount of chips out of that trade as you can. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.